How's it, guys? Today we will look at mitigation blocks. Just like always, we will look at the theory part first, then hop into the chart and look at a few market examples. Now, to begin with, what is a mitigation block? A mitigation block is a structural pattern whereby the market makes a low, a lower low, then makes a high, then makes a higher low, then proceed by breaking this previous high by making a higher high. So when this higher high happens here, our last up candle here is our mitigation block. So the market makes a lower low, then makes a high, then fails to make a lower low here. It doesn't make a lower low. It doesn't make a low below this low. Instead, it makes a low that is higher than this low. So it's a higher low. Then proceed by breaking structure to the upside down by breaking this low and making a higher high. So when we see this higher high happens, then we know that the last up candle here before this break of structure happened, the last up candle here, it's known as our mitigation block, right? So similar with a bearish move is we have the market makes a high, a higher high, then making a low, then making a lower high. It's a lower high because it's lower than the previous high. So this makes it a lower high. Then the market proceed by breaking this low here, making a lower low. So this is a lower low because it's a low that is below this low. So when this break of structure to the downside occurred, what happened is our last down candle here, our last down candle here before this break of structure to the downside happens, this becomes our bearish mitigation block. So what you do after the break of structure to the upside, the last up candle here is our mitigation block. So what you simply do is you wait for this break of structure, then you wait for the market to retrace into either the open of the mitigation block or the 50% of the mitigation block. Then that's what you say, that's what you buy. So your entry is going to be something like this, either you at the 50% or at the open. So let's use the 50%. I like refining my interest to the 50%. So what you target, either you target the first high or you target an old high that you have identified with your top-down analysis or your daily bias. So where do you keep your stop loss? You can keep your stop loss below this mitigation block, or for a safer part, you can put it below this low here, because of this break of structure to the upside down, the market structure shift, we know that this low is protected. That means that the market has no reason to come down to this low again. So you can safely put your stop loss below here. But if you're confident that the market is going to go up, you can put your stop loss just below this mitigation block. So for a bearish example, the market makes a high, a low, a lower high, then break structure to the downside. We have a market structure shift to the downside. Then the last down candle here before this up move becomes our mitigation block, right? So what you do after this break of structure, you wait for the market to retrace into the mitigation block. Either you take your sell position at the open or at the 50% of the mitigation block, and you target your higher time frame PD array or whatever high or whatever low that you deem you see it's a good fit. So where do you have your stop loss? Above the protected high here or above the mitigation block, right? So, but let me reiterate one thing, guys. This is a structural pattern, right? All structural patterns do not work if you do not have your bias. So you must know where your bias is going. So from your daily, your 4 hour or your 1 hour, 15 minutes, depending on what you use to identify your bias, that's when you can use. So here our bias is bullish because we have this higher time frame PD area which has been taken, right? The market went below a certain low, which is a PD area, or it went below, it went into a fair value gap or an order block. So we know that when the market get to this higher time frame PD area, it's highly likely that the market will target a higher time frame PD area on the opposite direction. So now we know that the market took sell side liquidity. Now the market is going to go and look for buy side liquidity. That's why our bias is bullish. So this structural pattern is useless on its own. So you have to find its correlation with the bias. Similar with the bearish structure, you have to know your higher time frame PDRS. So let's say this is a fair value gap on a higher time frame. You know that, okay, our higher time frame PDRS, the market respected a CB, sorry, a CB. So what does that mean? That means when the market goes to a CB, we will expect the market to fall. What does that happen? We have this low, then the market failing to make a higher high, signaling to us that the bullish momentum is failing, and now we are going into a bearish momentum. This break of structure or market structure shift here is a further confirmation that now we are confident that the market is going down. So what happens from here? When this break of structure occurs, then that's when you can trade this structure properly. Okay, guys. Now that was the theory part. Now let's go to the chart and look at a few market examples. Okay, guys. Our first example will be on Nasdaq 100 on the 5 minutes time frame. Okay. So before we look at the structure or the pattern of the mitigation block, let's first look at our buyers. So let's go to the left and see. So when you see here, when you scroll to you realize that we have this huge fair value gap here. The fair value gap, our PDRA, and the market is respecting the fair value gap in that it is not closing below the fair value gap. So now we can look for trades in the opposite direction. What does that mean? Now we can look to buy. Right? We have this PDRA, and we also took out this sell side liquidity here. You got this sell side liquidity. So now we are confident that the market is going to go up. So what do we do? Now let's look for the pattern. So we have the market making this high, then the market making a lower low, then the market making a high, then the market failing to make a lower low, instead making a lower high. So this is a lower high because it's higher than this previous low. So the market then proceeded by breaking structure to the upside. We have a break of structure or our market structure shift here. We have our market structure shift here. This is our market structure shift. So when we see this market structure shift, we look between the leg of this low and this high. So what is our mitigation block? Our mitigation block will be the last up candle before this break of structure. So we have this as our mitigation candle, right? We have our mitigation candle here. It's our last up candle before this low was made, right? So now what do? You wait for the market to tap into the mitigation block, then you take your entries there. So it's going to be something like this. So I like using the 50%, but if you use the 50% here, you are not going to catch a trade. But let's assume that you use the open of the mitigation block. So you put your entry here, and either you hide your stop loss below this mitigation block or below this fair value gap here, because this is also a fair value gap, below this fair value gap or below this mitigation block, or you hide your stop loss below this low. So where do you target higher? Scroll to the left again. Then this is our highs. So we have a high here, which is relatively close to this one, so we can target this high here. So let's go. You target this high, and you hide your stop loss below this protected low. It's protected because the market is unlikely to go into this fair value gap before going into this high time frame liquidity, because we have a fair value gap here, which the market can tap into this liquidity and come back and tap into the fair value gap before going up again. So now you target the first high that you see, or the most obvious high that you see, which is this one. So to increase your risk to reward ratio, you hide your stop loss above or below, below this mitigation block here. Okay. Okay, our next example, still on US 100 on the 5 minutes time frame. So what do you do next? You look for your buyers. How do you look for your buyers? Go to the left here, and you realize that we have this fair value gap here, which is not which is unmitigated, which is not balanced. So we have unfair price here. So what do? Now you have your buyers that the market tap into this fair value gap, because it's not closing above the fair value gap. That means it's respecting the fair value gap, telling us that the market wants to go down. Our next confirmation is we have this high here, which is our buy side liquidity. This is our buy side liquidity. Now we took buy side liquidity from the upside and we tap into an old fair value gap. So now we are looking for price to go down and attack this low and this low, and also possibly this low. So you can drag this out here, the fair value gap that I was talking about. You can say this can become your target, and you target the 50% of it. Now we have our buyers that the market is from this fair value gap and it's going to this fair value gap here or below this low. So now we are looking for the structure. We are looking for our pattern, right? Our mitigation block pattern. So we have this higher high here, then we have a low, then the market fails to make a higher high here. So when the market fails to make this higher high, we have a lower high. So this means that bullish momentum is dying off, and now we are going to experience downward movement. So now we proceeded by having this break of structure here, or a market structure shift to the downside. So what you can do is you mark your last down candle before this break of structure, which is this one, and this becomes your mitigation block, right? This is your mitigation block. So what you do, your entry would be something like this. This one is perfect. See, so we have the 50% here, which is expected, but let's just assume again that you are using the open, right? This is the open. Then where do you hide your stop loss? You can either hide your stop loss above this protected high here, or this high here, or just above this fair value gap here, this one. So where do you target? You already know your target is either this liquidity down here or this fair value gap, 50% of this fair value gap. So you buy, you sell here, and you buy back your position here, right? So the market makes a high, makes a low, makes a lower high, then breaks structure to the downside. Then this becomes your mitigation block. Then your mitigation block here, it get respected. You take your sell there and you target downwards liquidate, right? Okay guys, so this will be the end of our video. We discussed the theory part of our mitigation block, and we went into the chart and looked at two examples, one for bullish mitigation block and one for bearish mitigation block. So if you like this information, please subscribe, like, and comment to this video, and suggest future videos, and we'll see what to do about that. Catch you next time. Peace out.